What does this mean for equities, Manish? You've been negative for a while. Are you turning at the margin, or do you believe that there is still some pain?
So Neeraj, the case of, creating cash, of course, has gone away, in a sense, because of the two pillars that it stands on, or rather three. One is valuation. I think, valuations are sort of at historic averages, versus emerging markets, we are 10-15% expensive, but relative to how expensive we have been, we are 10-15% more expensive. But, that's give and take, that's being too cheeky about that, no, we'll buy only 10% lower. Versus bonds, I have to tell you, we may not have time, but in a sense, at 7.5-8% of bond yield, what is available to you is only 2.5% and max 3% excess yield, at markets level, and even lower for small caps and mid caps. So if you are dialing an equity, you should assume that if you buy here, you perhaps would only earn 2.5-3% more than bonds. That's the valuation argument. The second argument, of course, is the flow argument, and there's a little bit of a paradox here. One is that the FII selling, the cyclical bottom may be in, okay, is for the reasons that the macro that we discussed. But structurally, if we are going to discuss Neeraj in 2032, I would not be surprised if FIs actually net sold India or bought very marginal amount for the structural reasons, mostly to do with the demographics, because the retirees are going to draw down from their wealth. On the opposite spectrum, this locals cyclical peak is perhaps in, because they have a credible choice of a 8% bond yield, which is a competitor to otherwise sort of for a more nuanced guy, 11% yield in equity with twice the volatility or thrice in certain cases versus 8% bond. So I'm saying a lot of money could actually flow to bonds. So in a sense, there's going to be flip. I think in near term you will have FIIs actually sort of slowing, but structurally I think that FIs will continue to be sellers. And locals will continue to be buyers structurally, but the cyclical peak of their money coming in is actually in. So again, you have to. Broadly, if I sort of, when we discuss finally the big picture markets, people like me who like to buy good macro and liquidated markets, we're not yet in. But people who are in the business of being market is your audience, you ought to be a little contra. The net returns available to you over long periods of time is going to be very low, okay? But then you're going to have far too much, volatility over next 3-6 months, 12 months, and you will see these euphoric conditions as well as very pessimistic conditions, and play contra instead of momentum, which has been a key, feature of last 20-25 years of markets. For novices, of course, SIPs you must continue, but if you could be overweight at margin, money should be deployed in bonds instead of equities. Is how I think of markets.
So you're not turning your opinion per se right now. Large money, bond versus equities. Within equities, maybe for not an expert, the SIP route stays, but for an expert, there might still be better times to put in money, even if the person doesn't sit on cash.
Selling and if you're a regular guy, you have nothing else to do but stare at the screen, at least be contra and don't buy into this narrative that India's golden age is ahead for us. No, it's not. We actually face extraordinarily ugly exteriors, which our generation hasn't seen. A disintegrating world order, troubled geography with two-front war, energy scarcity, and extreme weather and soil erosion and persistent inflation. So, and along with that, at this move of China plus actually resulting in reshoring, where there is a bit of a boom going on in North America in terms of capex, putting a lot of pressure on wages there, and which basically means that a relatively longish cycle of tight dollar. So all of these are structurally very bad for markets if you were thinking of 3, 5, 10 years out. Okay, but in this 3, 5, 10 years, as long as you don't buy into this narrative that buy and forget, instead you buy into my narrative that on liquidation buy, and if macro turns worse, get out and make that money, and as and when bonds give you reasonable opportunity, hide there. I think that's a better strategy, Neeraj, than the alternate that just forget, buy into equities and don't even bother. That's for an active guy. I mean, 3% more or 2.5% more, given the tax, efficiency of equity. Is it all right? Yes, and which is why SIP for an average investor should continue.